So when the tide goes out, we get to see who's swimming naked. That's rising tide lifts all boats. It's an old Chinese proverb, goes back probably 5,000 years. Not as old as the Georgian wine, but a good number of years ago. A rising tide lifts all boats. That's true of the stock market. When the market is going up, it tends to lift all stock prices up. But as Warren Buffett has remarked, and he was not the originator of the phrase, but he has used it, when the tide goes out, you get to see who's swimming naked. I started the first 5-minute program by talking about Georgian wine 8,000 years ago. So let me take you back to start this whole thing. Let me take you back to 1876 to set the stage. 1876, there was a legendary professor in Edinburgh University by the name of Joshua Bell. New students were arriving, and Bell was demanding that they observe what was going on. He pounded the theme again and again and again. He said, little things are very, very important to observe. Distinctions, endless, significant trifles. And as the new students were there, it was kind of, yeah, famous professor, but, with all that minutia, it really gets to us. So eventually, Bell called the first patient. And I wish I could speak with a Scottish brogue, so you just have to imagine that it is the Scottish brogue. But he called the first patient. And the man walked in and stood. And Professor Bell walked around him slowly once and then twice. And Bell remarked, Army, recently discharged, probably Scots Highland. Aye, sir, the man answered. Bell was right. Next, Bill commented, non-commissioned officer, like in the West Indies, maybe Barbados. Aye, sir, again, the man replied. And every time Professor Bell commented, the man responded yes. Said, the man appeared courteous. So Professor Bell explained what he observed. He said the man appeared courteous and respectful, but he didn't remove his hat. Members of the Army don't do that. So likely he was a member of the Army and also discharged. He said, by the gait and tone, it was probably Scottish and probably from the Highland Regiment. He had an air of authority, so he was probably an officer. He had some mild elephantitis. That showed up on his arms, so he probably was stationed in Barbados where they'd had a recent outbreak. And the class was really impressed, really impressed. One particular student was awed by what he said. And the student went to see Bell. And when he knocked on Bell's door, Bell, without looking up, said, what you worried about? And it was a surprise to the student. The student said, how do you know that I was worried? And Bell said, you knock 4 times. If you're timid, you knock once. Most men knock 2 or 3 times. But when you're worried, you knock 4 times. Time and again, that student watched Dr. Bell make amazing deductions from simple observations. And that student vowed that he would never forget Dr. Bell. And he never did. And we will never either. That student made sure of that, because after he graduated, he hung out his medical shingle. But unfortunately, there was an outbreak of health. And to avoid starving, that student turned to writing. And he wanted a new type of character. So he chose a detective who was incredibly observant, someone like Dr. Bell. And for a sidekick, he picked somebody curious, but not so observant, a doctor like himself. And thus, Arthur Conan Doyle, even as Dr. Watson, stood in the shadow of his great hero, the Dr. Joseph Bell. who he called Sherlock Holmes. You won't forget Dr. Bell either. Sherlock Holmes. Investing, and as we begin to talk about these on the podcast, investing is a lot like deduction. It's observing the details, observing and interpreting from a huge amount of data and news, and not just taking simple opinions. And as we go through these workshops, it's truly, truly important to understand what's going on. So I hope that helps. So let's get started. Two kinds of strategies. Strategy of momentum or tactical or trend setting, and fundamental, sometimes called strategic. I'm fundamental. Observations and details really matter with what I do. But tactical is essentially the belief that the full story is in the stocks. The stocks understand what's going on, and the stocks, you can tell where things are going just by looking at the volume and the price, because all the news is already known. You hear that comment time and again. If you listen to CNBC or Bloomberg News, people say the news is already in the stocks. You tell me, stocks are inanimate. It's like saying the news is already in the rocks, because stocks are nothing more than things that are registered in a ledger. They have no brain, they have no knowledge, but you hear all the time, the news is in the stocks, because the feeling is that the stocks tell the story, the price and the volume. One of my favorite stories is out of the economics textbook written by Paul Samuelson, who during the 60s and 70s wrote the most popular textbook. He said that the stock market has correctly predicted 9 of the past 5 recessions. The news supposedly is told by the stocks. But it's really logical. It feels so good. It seems to feel like sell high, buy low, and by looking at the charts, you can tell what's a high and what's a low. You know, that's where things supposedly go. I'm always reminded when I talk about tactical investing of the story about Will Rogers. You know, Will Rogers was running for president, and somebody asked him, "How do you buy stocks?" And he said, "Always buy stocks that go up." And they said, "But sometimes stocks go down." And he said, "Yeah, if they go down, don't buy the stocks." It feels so good to only buy stocks that go up. And it seems so good when you listen to people talking about what's going on to buy stocks that only go up. Things like death crosses, Hindenburg, Omen, the bearish abandoned baby, the cup and saucer, the double top, the double bottom, the higher highs and the lower lows, increasing volume, decreasing volume, candlesticks, stochastics, all those things that go into that. But you know what goes on? When you're dealing in it, and studies show that over half of financial advisors are now using tactical approach to buy and sell. We've been through some tough times, but most financial advisors, the majority of financial advisors, are using momentum and tactical approach. But in doing so, you know who they're competing with? Computer algorithms. Algorithms that have been written that make all the trades without ever a human interaction. Computer algorithms are now making 95% of the trades, at least 95% of the trades that are done in the market. But of the orders they put in, They put in 100 times that number of orders, because if they put in an order to buy a stock at 30, they also have one at 30.001, 30.002, 30.003, 30.004, 30.005. And if they fill at 30.001, all those other orders disappear. 95%. No. Analyst, buy side analysts, sell side analysts are writing their reports to be read by computers. I want to tell you, I had a radio program, and one of the guests on my radio program, I interviewed guests. One of the guests was a young man who wrote a computer algorithm for peer-to-peer lending. And he described what goes on. Peer-to-peer lending, Greentree releases their loan originations on a Thursday at 1 o'clock in the afternoon or 2 o'clock. I don't remember if it's 1 or 2, doesn't matter. He'd written an algorithm that went in as soon as those loans were released and became public. The computer algorithm would look at all those loans. It would sort all those loans into highest to lowest credit quality. It would then, he was selling the loans, repackaging the loans, selling them to some of his clients. It would repackage those loans into $1,000 increments, buy the loans, and allocate them to his clients. All of that was done in a second and a half, less than 2 seconds. The analysis of credit quality was done. The repackaging, the loans were purchased, the loans were repackaged into $1,000 increments, and the loans were allocated to his clients. All of that in a second and a half, before a human being could even read the name of the first loan. The best loans were all gone. You know, he sold that algorithm for $500 million and moved to France, never became a client. But I always found when you're competing with computer algorithms, they understand and can read hundreds of millions of pieces of data in milliseconds. So Money, there's a quote from Money that I picked out called, "Timing the market is basically playing poker with the best players in the world who play around the clock with nearly unlimited resources. There's only so many poker chips on the table. It's a zero-sum game. So to think you're going to take chips from guys who have the computer algorithms is wishful thinking. It's delusional. This is a world game going on, and only a handful actually make money. And they make a lot by taking chips from players who aren't as good. As the old saying goes, if you've been at a poker table for a while and you don't know who the sucker is, it's you." That's tactical investing. It sounds so logical. It sounds so reasonable to buy at the low and sell at the high. That is the fundamental, is the tactical, strategic, technical analysis that goes on. And it has not proven to be one of those sides that's outperformed the S&P 500, even with the computer algorithms. The fundamental actual investing is the approach I use. And it's understanding that stocks have a price and a value. And the value is what the stock is actually worth. The price is what people are willing to pay for it. The late Art Cashin was a floor broker for Payne Weber, UBS. And he quoted Baruch and put it into modern terms. He said that the stock market's a perception market. When it believes that 2 + 2 = 5, it'll pay 4 3/4 for it all day long. My corollary to what Cashin said was, when the market believes that 2 + 2 = 3, What they bought at 4 3/4, they'll sell at 3 1/4 all day long. We know that 2 + 2 = 4. That's the value of a stock. The way fundamental investing works is you look for those things that are priced at 3 1/4, and you buy at that point and you sell at 4 3/4. Doesn't always work. But that's the philosophy. And those are basically the two approaches we're talking about. What we've been living through, what we've been living through is an expansion since 2009, which has been pretty much up. The Dow in 2009, March of 2009, had hit 6,600. Today it's over 46,000. From 6,600 to 46,000. The Standard & Poor's was under 800. Now it's 6,600. NASDAQ was 1,300. Now over 22,000. And yeah, we had a setback in 2020 with COVID. But the Dow from 6,600 to 46,000. I used to do radio programs in 2011 saying it's not impossible to think about the Dow at 100,000. That's when the Dow was around 9,900. We've been in expansion. And not only has the Dow been expanding and the stock market expanding, we've been in the time when the GDP has been expanding, the US GDP. And not only the US GDP, but worldwide GDP. But during that period of time, COVID, of course, was the most notable correction. But understanding what corrections really are. There's two types of corrections. Between 1950 and 2014, there's been a correction almost every other year. Every other year, we see a downtime. And it's arbitrary where we say corrections are down 10%, bear markets are down 20%. Those are just arbitrary numbers. There's nothing in the world that says corrections are always 10% down. Who knows? Some corrections are maybe 5%, some are 15, some may be 25. What we do know is that most corrections, every other year, most of those corrections are shrinkage in the multiple, what's called the multiple. The multiple is the price-earnings ratio. If you take the price of the stock and divide it by the earnings, you get what's called the PE ratio. The PE ratio and then in a normal situation runs between 15 and 22. If you look at what it really means in terms of long term, it means the willingness to pay a given price for the earnings of a stock. And if the earnings are going up, you should be able to pay a higher price than if the earnings are flat, and a much lower price if the earnings are down. Most corrections are simply a shrinkage of the PE ratio, going from 22 to 15 or 22 to 17 or going from 19 to 15. Most corrections are that. News comes out, people are worried, people were worried about the tariffs when they were set in. It's not that earnings collapsed. The companies continued to do well. It was the fear setting in, people selling, and a contraction of the multiples. In most cases, revenues continue to rise, earnings continue to rise. And so what you get is this perception. 2 + 2 was 4 3/4 equal to 5. So people were buying at 4 3/4, but suddenly you get a correction where suddenly people begin to believe that 2 + 2 = 3 1/4, and you get stock prices coming down. That's what most corrections are. But there are times in which GDP trails off. We saw that in the Great Recession, 2007, 2008, 2009. We saw that in 2000, where we saw actual economy slow down. Those corrections, those bear markets are very different from the standard correction where all you're getting is a shrinkage of the multiple. That's just the shrinkage when you divide the price by the earnings, you get the price coming down, so you get a shrinkage in the multiple. What happens in a real correction, an economic correction, is that the earnings begin to fall off. The revenues begin to fall off. That's what we saw in 2000 and 2008. It's not dependent upon the revenue. It's not dependent on the shrinkage. It's dependent upon earnings. We saw that in 2008. I'm repeating. 2000. We saw that in 1929. All of those times. Why I spend so much time on stagflation is it's not a short-term thing. It's actually when the economy contracts. You know, most people look at corrections as being one correction is like another correction is like another correction. Not really true. Going back to Professor Bell, it's observing what's going on. It's not that the news is all baked into the stock price. It's understanding all the fundamentals, all the details, all the observations of what's happening to understand the reaction. In normal corrections, you just wait it out. You know, it's financial advisor holding your hand. Everything's going to be fine. Just wait it out. The price earnings ratios are going to return to what they normally are. Just hang on. In an economic turndown, it's very different. Price earnings ratios are not going to return to what they are. You have to find the right place to be. You know, and I'm older. I've been around a long time. Most money managers and a lot of financial advisors today are under the age of 40. That means most of them have never been through a real bear market. The economy was actually shrinking. I've read about 1929. My parents went through the Great Depression. You read about it. You read about the people that lost all their money in the Great Depression. And I have a story about that. Back when I first licensed, I licensed in 1986 as a stockbroker. Now we call stockbrokers financial advisors, but back then I licensed as a stockbroker in 1986. And one of my first clients, in that day, you took anybody. When you're starting out, you take anybody that can fog a mirror as a qualified client. And one of the people that came on board was an 80-year-old man who said he wanted to do margin. He wanted to buy stocks. He wanted to do them on margin. I said, okay, I'll take you. We did margin. That didn't really impact me until 1987, October 19th, 1987, when the market fell off 500 points. He got a significant margin call. I knew on the next day, on that Tuesday, that I was going to have to call him and tell him he had a margin call. I avoided doing that. I waited. I put it off all day. It was probably around 5 o'clock on the 20th when I called him to tell him that he had a margin call. Not a margin call, significant margin call. I didn't know if he was going to yell at me. I didn't know if he was going to say, I'm going to sue you. All I knew is putting somebody 80 years old on margin didn't meet the criteria of what I should have been doing. I was young. I wasn't that young, but I was naive in putting an 80-year-old man onto margin. So when I called him, he picked up the phone, he answered the phone, and I said, Herb, we have a margin call. I didn't know what he was going to respond, but his response took me completely by surprise. He had a high voice. He talked kind of like this. And what he said to me was, he started to laugh. He started to laugh. I'm saying he's got a serious margin call. He starts to laugh. And when he did speak, what he said was, you know, I was on margin in 1929. I was on margin in 1931. I was on margin in 1937. I was on margin, and he listed a few other times. And he says, let me tell you something. He says, the market between 1931 and 1937 was the best market I've ever lived through. And to me, that was a complete shock. All I'd heard about is people losing everything in the Great Depression. And here's somebody telling me that the best market was 1931 to 1937. I looked it up after our phone call, and sure enough, the returns in that market from 31 to 37 were pretty phenomenal. But I spent a couple hours with him because he started to tell me back in the 1920s, he had been a customer's man. That's what you called stockbrokers back in the 1920s. He said his training was taking the ticker tape and writing the stock prices on a blackboard, or on a blackboard. He said 1929 was a very special time, but we spent a lot of time. We spent 2 hours on the phone, and he said, this is how you handle margin. You always sell. You never put money in. You always sell to play another day. Always sell. We talked for 2 hours. He said 1929 was a time in which trading overpowered technology. 1929, when you bought a stock, you would give a ticket to a wire operator who sent it to New York to be executed. It would come back, the playback would come back with another report from the stock to the wire operator. And then you matched the ticket going in, the execution of the order, and you matched those up. He said 1929, October 1929, Black Monday, there were so many orders that went in and confirmations coming back that in order to match those up, they rented every single hotel room in the city of Seattle, laid it all out on the floor, and spent days matching the orders going in with a confirmation coming back. That's the difference. I've lived through the 70s. I've lived through stagflation before. I never would have guessed that being in that time of 1929, that market would have been that kind of market. Nor would I have guessed on how you handle margin. It's not what they teach you. It's not what you're told by firms. Most firms shy completely away from it. It's not considered safe. It's all those things. Herb taught me a huge amount. That's the advantage of having been around a long time. The difference between fundamental and technical is the difference between renting and owning your own home. With fundamental investing, you're buying a stock, holding it for the long term. With technical, you're simply depending upon the price and the volume to determine what to buy, when to sell. And it's the difference between buying a home and renting a home. That's an analysis that I use. And I've talked about stagflation. I think it's important to talk about what's coming and what happens, because bear markets are tough. Bear markets burn the financial advisors. They burn the clients. Experienced financial advisors who have been through a bear market tend to deal with it in a different way. They tend to understand it's not hand-holding. It's not saying just hang on, things are going to get better. It's the Mad Magazine, Alfred E. Newman, cheer up, things could get worse. And sure enough, I cheered up and things did get worse. That's the bear market. It burns. And you can read about it. I read about the Great Depression. I knew a lot about the Great Depression, but never did I know that between 31 and 37 was one of the best stock markets in the 1900s. I never realized in the 20th century how good a market that was and how much money you could make. And most of us now have been through the Great Recession of 2007, 2008. It was a very short period of time. 3 years, very short. COVID was even shorter. COVID was 160 days long. The bear market of 2007, 8, and 9 was less than 3 years long. That's not normal. Bear markets usually last about half as long as bull markets. So if we've been in this bull market since 2009, when the Dow was 6,600 and now 46,000, we've been in this market for 16 years. As a rule of thumb, that means the next bear market's going to be 8 years. Not going to be like the Great Recession. It's going to be much, much longer. You know, we experienced that. We lived through that. You probably know people who lost their home. Probably know people who lost their job. You probably know people, or maybe you were one, who worried about losing your job. Unemployment, 10%. You know, I think there's a very significant probability that we're headed to a period of stagflation. Stagflation, when stocks don't work, when bonds don't work, real estate probably doesn't work, commodities work at times and not at other times. When things are really tough, going back to 2007, 2008, that time period, nothing worked. Bonds didn't work. Stocks didn't work. Commodities didn't work. Real estate didn't work. Everything took a drop. You know, whether you're fundamental, whether you're tactical, it doesn't make a difference. It burns clients. It burns advisors. If you go back to the 1970s, what did work was to own individual stocks that were growth, and coming out of that, even during those tough times, they did well. It's difficult. It doesn't have to be. It doesn't have to be for you. It's a matter of finding, in my opinion, finding the right advisor. Jackson National did a study they did a big survey of financial advisors back, and the data is pretty old, but it's the most recent I could find. And I've been using it for a long time. Back in 2011, 2010, Jackson National did a survey and found that 75% of financial advisors believed that they outperformed the S&P 500. 75%. In my opinion, it's not unusual. It's not a surprise. If you're in a large group of people and you ask how many people are better than average drivers, 75% of people will hold up their hand. I'd be one of those. I don't know if I'm better than average or not, but I think I am. Who knows? You know, financial advisors, they don't publish the results. You don't see the results. You don't have a chance to see how they're doing. They don't have a chance to see what they're doing. They just know that it's a thing which most big brokerage firms push. I worked for those big brokerage firms for 18 years. The mantra was sell the relationship, not the performance. We don't want you to know what your performance is. We want people to like you, regardless of how poorly they do. It's finding the right advisor. Cerulean Associates, Jackson National, for that period of time, found that 75% of advisors felt they outperformed the Standard & Poor's. Cerulean Associates picked that up and actually did a study of financial advisors and found that the average return for those financial advisors over that time period of 2010, 2011, their actual performance was 4%. The Standard & Poor's was up 17%. Adams Financial Concepts were up 26%. It's old data, but I would guess that it's pretty close to what is going on today. You know, unlike most financial advisors, and now I have to pat myself on the back, we actually do publish our returns. We take into account every account, every client account that's invested in all in equities, from conservative to aggressive accounts. We have a few aggressive, mostly conservative, mostly moderate, but a few conservative as well. We combine all those into a composite. The report is done by a third party. We're not doing the reports. We hire a third party at Bison to do it. Before that, it was Morningstar. Before that, it was Advent. They take the data directly from our custodian, Interactive Brokers. They take it on a daily basis, what stocks are doing, what cash goes in, cash goes out, what the dividends are. They take all that information, compile it client by client, account by account, and they put together a report. We furnish that report to our clients every quarter, and we compile it. It's compiled into a composite. It includes accounts that have been with me since the 1980s, 1986, through accounts that opened with just at least 3 months of data. It includes all the accounts that have left for whatever reason they left, whether they passed away, whether they decided they wanted to go somewhere else. And that happens. We have clients that do leave, but we compile all that data into a composite every quarter, and then we publish that. When we compare it to the studies that are done of financial advisors, that's the lower line. The upper line is how our clients have done. Our clients, starting with 500,000, would have grown it tenfold, almost tenfold, 4.9 million. The average financial advisor, according to the studies done by a number of people, would have doubled the money instead. And I can tell you that we're up in this range right now as we go into the fourth quarter. We've had a good year. We're outperforming the Standard & Poor's again this year. But that's my pat on the back. And we always have to have a lot of disclaimers. Past performance is no guarantee of future performance. We compare ourselves to the Standard & Poor's 500 with dividends reinvested. That's the report that goes out to clients on each account, shows that in their household accounts. We include all active accounts, as I explained. They don't include our profit sharing accounts, but there are growth accounts showing where we are. That's what it's about. That's our focus. And we think it's going to be crucially important as we come forward, looking toward a period of stagflation. We think there's a significant chance of that. The head of Chase just came out and is also saying that. You might have heard him saying that. There's been a few other people who've been around a long time, people that are in their 60s and 70s and 80s have been are beginning to predict we have the potential to go through stagflation once again. Stagflation, where you have inflation running away and a recession at the same time. 1970s, we saw double-digit inflation. At the same time, we saw double-digit unemployment. 2007, 2008, we saw 10% unemployment. 1970s, in the midst of stagflation, we saw 10% unemployment. Well, prices were shooting up like a rocket and coming down like a feather. That's what we're preparing for. We've been preparing for that for a while. We think it only makes sense to be there. And with that, that's where we are. Differences between investing. We're a value investor, not a value investor. We are we're a fundamental strategic investor. We realize that the stocks have a value that they're actually worth and a price which people are willing to pay. We're looking for those times in which 2 + 2 = 3 1/4 to buy, and we're looking to sell when the market believes that 2 + 2 = 5. We're willing to sell at 4 3/4. We don't believe that the news is all in the stocks. We believe that the market is inefficient in the short term and efficient in the long term. That's the difference between us and momentum. We believe the stocks are inanimate. They don't know who you are. They don't know what the news is going to be. They don't know what's coming on. They realize that the stock market is made up of millions of people making millions of different decisions based on millions of different psychology. And that doesn't tell you what's going to happen in the future. I think it's a matter of being like Dr. Bell, to look back and see and observe and look at the minutia of what's going on. That's where we are. And that's why we get the results we do. So with that, let me come back and ask if there's questions and discussion. Back to you, Chris.
Hey, Mike, I'm back. Thank you very much for that. That was a super informative presentation this week, and I'm really grateful for that. Everyone who's here today, and thank you. We have a really nice audience today. I've just put into the chat. If you're interested in having Mike just put a fresh set of eyes on your portfolio, I know he's always happy to do that. Mike, I offered that on your behalf. No strings attached for that, not a sales call in disguise, just helpful insights. I put his email address in the chat. All you have to do is click on that, start a new email, and just drop Mike a quick note and say, hey, I'd love for you to check out my portfolio. He does that as a courtesy for the people who show up on these things. Mike, a question that somebody's asked is it possible to make money during a bear market?
It is. If you look back I use these examples all the time. So if you heard it, you can just say, I'm old, and so I repeat my stories. But it's a really important story to understand. If you look back into the 1966 to 1982, that bear market that happened then, the Dow hit 1,999.99 in the middle of 1966, then dropped 20%, got back to 1,000, dropped 30%, back to 1,000, down 40%, back to 1,000, down 20%, and finally through 1,000 in August of 1982, 16 years later. But during that period of time, even though the stock market went down, there were companies that did well. We think that they were companies that fell in 3 categories: changes in demographics, changes in lifestyles, changes in technology. If you look at one of the lifestyle changes, there was a little company that came public in 1966 as the market reached its peak and started down. It was a little restaurant company that had no place to sit down, that you had to drive through and pick up your meal at a time when restaurants were all sit down and order and wait for the wait person to bring your money, to take your order, take it to the kitchen, have the food cooked and bring it back. This prepared all the food beforehand. You drove through, and they sold 19-cent hamburgers. Had a dramatic change in the way we do restaurants. Of course, the company was McDonald's. Investing in that stock turned a 10-fold profit. Invest 10,000, you had 100,000. Invest 100,000, you had $1 million. That's what that did during that period of stagflation. There was a little radio repair company. Back in those days, radios had tubes, TV had tubes. You had companies, or you had little repair shops that were along the corner or along strip malls or wherever they might be. If your radio went dead, you'd take it into these places. They would test all the tubes, find the bad tube, replace the tube. Little company or little little shop in Colorado that realized the potential of the transistor, replacing all those tubes, and began to distribute the transistors and other electronic equipment. That was Arrow Electronics. They grew 20-fold during stagflation. Invest 10,000, it turned into 200,000. Invest 100,000, turned into 2 million. There was a company that on the technology side that developed random access memory. I can tell you in 1972, in the middle of the stagflation period of time, I bought the stock at 10, sold it at 30. For years, I was so happy having done that. I found out when I became licensed as a stockbroker in 1986 how stupid that decision to sell was, because that stock went from 10 to 1,756 a share. Now,
Wow.
I sold at 30. There were companies that were involved in changes in demographics, changes in lifestyles, changes in technology that did very well. And I've used those examples over and over again. So I keep telling the same story, but it's really a valid story. That's where we want to be. That's where our clients are right now. We're looking forward to, I can't say we're looking forward to stagflation, but at least we're prepared for what's going to happen.
Thanks
So,
for that.
long answer to a short question.
That was a great answer. Somebody's fondly recalling when drugstores had the big tube testers.
Drugstores, what was it? They had to be tube testers. They had a soda fountain. They began to carry more and more products. It was the old joke in the 1960s that the person that goes into the drugstore and says to the druggist, "What kind of drugstore is this that you don't sell used cars?" They sold everything.
Another question that has come up: how long do you think it will be before AI replaces trading and investing professionals?
Computers came out in the 1960s. Actually, in the 1950s, we started to see the first computers. People were programming in machine language. But to really reach the point where computers were replacing a lot of individual work was into the 70s and 80s. It took decades. Go back and trace electricity. Look at Tesla, look at Westinghouse, look at Bell. It took a long time for electricity to really make it. AI is going to be that process as well. It's going to be much more rapid than we saw with electricity and computers, probably. But it's going to happen. And will it actually, can somebody focus on fundamental investing? It's probably going to happen. To date, it hasn't, but it will. Anyway.
Another question: what were the tickers that did well in the stagflation?
MCD, Advanced Micro Devices, was AMDV. I don't remember the ticker for Arrow Electronics.
Mike, that wraps up the questions that I have queued up. Once again, friends that are here in the chat, if you would like to have Mike take a look at your portfolio, I've just put his email address once again into the chat. All you have to do is click on that and send him an email. And Mike, with that, with no other questions queued up, I'm curious, what's the topic coming up next week?
So next week, there's been a lot going on. Okay, what am I doing here?
Maybe back to the presentation. I bet.
There we are. China's economic gold, is it really fool's gold? What does it mean for worldwide investments and especially the US stock market? Right now, you're reading in Bloomberg News, you're reading in some of the news outlets, financial outlets, that China's inviting a lot of people to China to look at their factories. They did the Made in China 2025, where they wanted to excel and replace America as the leader in electronic vehicles, in computer tablets and computer components, in agricultural machinery, in chemicals, in biology, bioengineering, and they made a list of in advanced materials, all those things. They have achieved a significant level of success, but is the house built on sand?
Mm-hmm.
The more I read, and having had a business, I had a business that I formed in the country of Georgia to deal with commercializing a former Soviet military plant into a commercial aviation plant. I dealt with a lot of people in Georgia, in Russia, in the Ukraine in that process. I got to see what it's really like to live in a centralized economy uh, and understand what goes on, not from the data, but from a personal perspective. And what I'm seeing in China and what I read has the same feeling from my gut as what I saw and heard and the stories about central government in Russia and in the Soviet Union. Next week, I want to talk about that and talk about what's going on in China. Is the house built on sand? If you're invested in Chinese stocks, it's probably not a good idea. I'm going to talk about that and talk about the impact on what it's going to have worldwide and on the US stock market, because it will have an impact. It's the second largest economy in the world. It's, of course, going to have an impact worldwide. That's next week.
So keep an eye on your emails and our social channels, and you'll be able to check those out. For those of you who are interested in the replay, we do have a YouTube channel. And Mike, I want you to tell them the name of that YouTube channel while I look it up to get the link into the chat.
It's called About Money Radio, established a long time ago when I was doing a radio program. Now we
And
do
that is where we put all of the recordings of these broadcasts, and they're usually there just within a couple of days. We'll make sure you get an email with that as well. And I just put the YouTube link into the chat, so you can go there and subscribe to that channel and learn even more from Mike. Mike, what an amazing program today. I know I learned something, and I'm grateful for you.
Thanks for being here.
Yeah.
Thanks everyone for staying.
Yeah. See you
And
guys next week.
next week, I think is going to be very interesting. No numbers, but observation, like Dr. Bell. And I'm not Dr. Bell, and I'm not Sherlock Holmes, but I'm also. Anyway, we've had a good track record because we keep at it. So with that, I'll close it out. Thanks for being here, and hopefully I will see you next Thursday.
See you guys next week.